Hello, welcome to this week's Market Carver. I am Andrew Thrasher, Senior Portfolio Manager for Financial Enhancement Group, joined by Zach Unger, Portfolio Manager. It's nice to get to say that for the first time of Financial Enhancement Group. We have two important topics to discuss this week, both things that one topic that you'll probably have seen in the news with headlines regarding the government potentially stepping back into the mortgage market, trying to push rates lower. And then we're also going to look at the energy sector, which continues to be unloved, but has a lot of catalysts behind it as we start seeing a lot of headlines around Venezuela, Iran, and things like that, making oil a bigger topic today. So the first one is what I'm going to be talking about. And that, again, is looking at the energy market. So the chart that I wanted to share this week was looking at all the money that flows in ETFs, exchange traded funds, and looking at what percent of all those ETFs that are equities, what percent are invested in energy ETFs. As you can see, it's really low. That line has continued to move down, and we're just now getting under the levels that we saw at the COVID crisis bottom back in 2020. What this is telling us is that investors have really almost no interest at all in taking on exposure to the energy sector, and possibly rightfully so. It's been a poor performer for a while. We've seen oil prices come down, energy stocks have underperformed, but I believe now is a time that where we want to start getting a little bit interested in kind of this contrarian play. We get interested when we start seeing everyone else has an opinion on something, this one being that energy is not the place to be, and we start seeing all these catalysts on the headway. We've discussed last week talking about Venezuela. We're now seeing Iran as the headline, and what a lot of analysts report, if we do see escalation continue in Iran, that could really put upward pressure on oil prices, which obviously would also bring up the energy sector as a whole. And we're seeing many other catalysts as well, as we're seeing a lot of other developing countries taking on more energy usage, a lot of the demand for AI and computers requiring a lot more energy usage. And so we just believe that while this sector looks like it's been left for dead, there could be long-term benefits that could help bolster this space. And so it's one we not necessarily want to jump all in, put all our eggs in that basket right away. It is one that we're continuing to watch as possible opportunity and trying to find a place where maybe the market could be wrong in the short term as long-term headwinds or tailwinds, I should say, start to carry the sector higher. So it's something that's on our radar, we're watching, but right now, as this chart shows, very few investors are putting any money into the energy space, and that's something we always want to be aware of. Now I'm going to turn over to Zach, who's going to talk about some of the headlines that you may have seen about the U.S. government buying mortgage bonds.
Yeah, so you'll see from the chart on the screen here in a moment, housing affordability. You can see down near the lowest levels since the late 80s, early 90s. And so the federal government has responded by stating their intent to have Fannie Mae and Freddie Mac step back into the mortgage buying business, purchasing upwards of $200 billion in mortgages. Keep from getting into the mechanics, it gets a little complex, but essentially what the market's telling us based on pricing right now is that there's about 0.25% to go for interest rates to come down if they were to enact this plan of buying all of these mortgages. The intent here is really to bring mortgage rates down, but as I mentioned, only looking at about 0.25%. Now that 0.25% could certainly be very meaningful for folks, people looking to purchase their first home. 0.25% can make an impact on monthly payments, certainly bring those down and make housing a little bit more affordable. It's also notable for folks that purchased homes in late 2023, 24, 25, when interest rates were high. That extra quarter point or so can make the difference in the choice of whether to refinance or not. So we could see more refinances start to come online, which then tends to lock up supply a little bit more. So this is really the big lever that the government has to impact mortgage prices or the interest rates on mortgages. Now, obviously, a lot of other inputs that go into this, housing supply being one of them. We've been perpetually undersupplied nationally. Obviously, some differences in independent markets or individual markets, but nationally speaking, we've been undersupplied for a while. And so if we don't see some of that supply come back online, lower rates can impact prices and maybe things get offset. It's a little bit more speculative, but what we are anticipating is that the government will step in, begin to buy mortgages in an attempt to start correcting what you're seeing on the screen here, making housing a little bit more affordable.
All right, thank you, Zach. Well said. Yeah, we're always kind of leery when we start seeing government get too involved in any one market, as there always can be ripple effects, both positive and negative, that can come with that. So it'll be very interesting to see what happens if and when the government does begin to start getting their hands back into the mortgage debt market. So those are our two topics for the Market Carver this week. We look forward to bringing more next week. If you do have any questions or would like to set up a meeting, you have our website phone number on the screen, as well as a QR code, and our team would be more than happy to field those questions or requests for more information. Thank you so much, and have a great weekend.